There's a major shift happening in the silver market, and surprisingly, very few people are paying attention to it. The signs have been building for months, yet most headlines continue to focus on short-term price swings instead of the bigger story. But once you understand what's unfolding behind the scenes, you may start looking at silver very differently. Right now, physical silver in Shanghai is trading at prices that are consistently well above COMEX silver. This isn't a one-day spike or a temporary imbalance caused by shipping delays. The gap has remained in place, and in some cases it has continued to widen. In a market that is supposed to be connected globally, that simply shouldn't happen. Think about what this really means. When one of the world's largest physical silver markets is willing to pay significantly more than the benchmark futures market, it's no longer something that can be dismissed as random market noise. It points toward a deeper structural issue that deserves attention. The real question is no longer whether this premium exists. The question is, what happens if the physical market eventually stops accepting prices dictated by the paper market altogether? If that happens, it could reshape how silver is valued worldwide, and many investors may not be prepared for that possibility. In today's update from AgJohn Silver Update, we're going to break down exactly why Shanghai keeps paying more for physical silver, why the premium refuses to disappear, what it reveals about real supply and demand, and why this growing disconnect could become one of the most important stories in the precious metals market. This isn't about hype or dramatic predictions. It's about understanding the mechanics behind what the data is showing us and why experienced market observers are watching it so closely. To understand why this matters, we first need to recognize that COMEX and Shanghai are built for very different purposes. COMEX, operated through CME Group in New York, serves as the world's primary pricing benchmark for silver. Whenever financial news reports the current silver price, it is almost always referencing COMEX futures. Every year, an enormous amount of silver contracts trade through this exchange, representing trillions of dollars in value. However, there's an important distinction many people overlook. Most of the activity on COMEX never results in actual silver changing hands. These are mainly futures contracts that are bought, sold, rolled over, or closed before physical delivery ever takes place. Only a small percentage of contracts actually end with someone taking possession of real metal. That's simply how modern futures markets operate. Under normal circumstances, this system works because arbitrage keeps physical and paper prices closely aligned. If futures become too cheap compared to physical silver, traders step in, buy where it's cheaper, sell where it's more expensive, and eventually bring prices back together. That's the theory. Now compare that with China's major precious metals exchanges, the Shanghai Gold Exchange and the Shanghai Futures Exchange. Unlike COMEX, these exchanges are heavily centered around physical delivery. The silver traded there doesn't simply remain a financial contract. In most cases, it leaves the vaults and moves directly into the hands of manufacturers, refiners, industrial users, investors, and fabricators. That difference changes everything. COMEX is primarily designed for price discovery through financial contracts. Shanghai is primarily a marketplace where real metal is bought, delivered, and consumed. When both systems arrive at similar prices, it tells us that physical supply and paper pricing are working together as expected. But when physical silver consistently commands a much higher price than paper silver, the message becomes much harder to ignore. It suggests that obtaining actual silver in the real world has become more difficult than futures prices would indicate. And that's exactly the trend we've been witnessing over recent months. The reason this growing price gap has attracted so much attention is because it is far beyond what would normally be expected in a healthy global market. Under ordinary conditions, silver traded in Shanghai may carry a small premium over COMEX prices. Transportation costs, taxes, currency conversion, import fees, and other routine expenses can easily explain a modest difference. Those kinds of premiums are completely normal. What we are seeing today is something entirely different. Throughout 2026, the premium has repeatedly expanded into levels that market participants rarely experience. Analysts following both exchanges have documented periods where silver in Shanghai traded at prices implying premiums well into double digits. Depending on the trading session, buyers have effectively been paying the equivalent of $10, $15, or even $20 more per ounce than COMEX prices suggested. The exact numbers change from week to week, and by the time you're watching this video, the premium may have shifted again. That's why focusing on one specific price isn't nearly as important as understanding the broader trend. The key point is that this premium hasn't disappeared. Instead, it continues returning again and again. That persistence tells us something much bigger than any single day's trading activity. Historically, the spread between Shanghai and COMEX has usually remained relatively small. Whenever differences appeared, They rarely lasted long because arbitrage traders would quickly move metal between markets until prices came back into balance. This time, that balancing mechanism hasn't fully worked. Now think about the practical reality. Imagine you're operating one of China's massive solar panel factories or producing electronics, electric vehicles, telecommunications equipment, or advanced medical devices. Silver isn't just another commodity sitting on a balance sheet, it's an essential manufacturing material. If your factory runs out of silver, production slows or even stops completely. Compared to shutting down an entire production line, paying an additional premium for physical metal becomes a relatively small cost. That's exactly why buyers continue paying these elevated prices. They aren't purchasing silver because they're optimistic about tomorrow's price. They're buying it because they need it today. Many explanations have been offered for this unusual premium. Some point to currency fluctuations, others blame shipping delays, tariff policies, import regulations, or temporary logistical issues. While each of those factors may contribute around the edges, none of them fully explains why this premium has remained unusually large for such an extended period. When you remove all the distractions, one explanation continues to fit the evidence better than the others. China's demand for physical silver is simply growing faster than available supply. The premium itself is acting like a market signal, reflecting that imbalance in real time. This also raises an important question about how silver prices are actually being determined. For decades, the accepted model has been straightforward. COMEX and the London market establish the benchmark price, while physical markets around the world trade slightly above or below that benchmark depending on local conditions. In other words, paper markets lead and physical markets follow. But Shanghai is beginning to challenge that long-standing relationship. Instead of waiting for futures markets to decide what silver should be worth, buyers in China are bidding higher based on immediate physical demand. That shift may seem subtle at first, but its implications could be enormous if it continues. Consider where much of the world's physical silver has been flowing over the last several years. China has dramatically increased imports from major producing regions, including London vaults, Australia, and South America. Despite these large inflows, the premium has refused to disappear. Normally, bringing more supply into a market should reduce prices. Instead, every shipment appears to be absorbed almost immediately. That suggests demand isn't just strong. It's consuming available supply as quickly as it arrives. And if that trend continues, the physical market may increasingly begin setting its own price, independently of what paper markets are saying. That's a possibility every serious silver investor should be watching very closely. What makes this situation even more important is that the price difference isn't being driven by speculation, it's being driven by necessity. Many people assume that if Shanghai is paying much more for silver, traders will simply buy cheaper silver through COMEX, ship it to China, collect the profit, and quickly eliminate the premium. In theory, that's exactly how an efficient market should work. In reality, it's far more complicated. First, the silver has to be available in a form that's actually eligible for delivery. Second, converting warehouse holdings into the specific bar sizes and purity standards accepted by Chinese exchanges takes time. On top of that, transportation, insurance, export regulations, customs procedures, and shipping delays all add friction to the process. For manufacturers that need silver immediately, waiting several weeks simply isn't an option. When production depends on having metal today, companies will gladly pay the higher price rather than risk shutting down factories. That's why the physical premium has continued to survive despite obvious arbitrage opportunities. This naturally brings us to another closely watched indicator, COMEX vault inventories. COMEX separates its silver into two main categories. The first is registered silver, which is already designated for delivery against futures contracts. The second is eligible silver, which meets exchange standards but belongs to private owners, institutions, or ETFs and isn't automatically available for delivery. That distinction is extremely important. Just because eligible silver is sitting inside a COMEX-approved vault doesn't mean anyone can simply claim it. It belongs to someone else, and unless that owner chooses to make it available, those ounces remain unavailable to satisfy delivery demand. Over the past year, analysts have consistently pointed to declining registered inventories while paper open interest has remained substantial. In simple terms, more financial claims continue to exist against a relatively limited pool of silver that's immediately deliverable. This isn't hidden information or speculation. COMEX publishes these inventory reports regularly, allowing anyone to follow the trend for themselves. Now connect this back to Shanghai. Whenever traders move physical silver from Western vaults into Asian markets to capture higher premiums, those inventories naturally become tighter. As more metal flows east, Western vaults gradually shrink. Smaller inventories create greater uncertainty around future deliveries, which under normal market conditions would eventually place upward pressure on prices. However, because futures markets involve enormous paper trading volumes, that tightening isn't always reflected immediately in benchmark prices. This growing disconnect between paper pricing and physical demand is exactly what has so many experienced market participants paying close attention. The story becomes even more compelling when you look at where China's silver demand is coming from. China dominates global solar manufacturing, producing the vast majority of the world's photovoltaic cells. Silver plays an essential role in every one of those panels because of its unmatched electrical conductivity and long-term durability. Despite years of research, no alternative material has been able to replace silver on a commercial scale without sacrificing efficiency or reliability. And solar is only one piece of the puzzle. Silver is also critical for electric vehicles, semiconductor production, artificial intelligence infrastructure, telecommunications, medical technology, aerospace systems, and advanced electronics. Every new factory, every new AI data center, every 5G expansion project, and every next-generation semiconductor facility increases the need for physical silver. This is an investment demand that disappears when prices fluctuate. It's industrial demand tied directly to ongoing production. Factories cannot simply pause because silver becomes more expensive. They still need the metal to fulfill contracts, keep assembly lines moving, and meet customer demand. At the same time, global mine production hasn't increased fast enough to match this growing consumption. Most silver isn't mined as a primary product. Instead, it's produced as a byproduct of copper, lead, zinc, and gold mining. That means increasing silver supply isn't as simple as opening another silver mine. Developing new mining projects often requires years of exploration, permitting, financing, and construction before meaningful production ever reaches the market. Recycling helps add supply, but it hasn't expanded quickly enough to offset rising industrial consumption. As a result, the market has experienced repeated physical deficits, with more silver being consumed than newly supplied. When that happens year after year, existing stockpiles gradually shrink. And that's exactly the kind of environment where physical premiums like the one in Shanghai become increasingly difficult to ignore. Whether the adjustment comes through higher paper prices, tighter physical supplies, or a combination of both remains uncertain. But one thing is becoming increasingly clear. The physical market is sending a message that deserves attention. The gap between where real buyers are willing to pay for silver and where paper markets continue to price it may prove to be one of the most important developments shaping the future of the silver market.